I am witnessing what may be the most consequential financial decision in modern European history. As I analyze the unfolding dynamics around Europe's $300 billion dilemma with frozen Russian central bank reserves, I observe not merely a policy debate, but a civilizational crossroads that will determine whether the post-war monetary order survives or fractures into competing spheres of influence. The European Union now stands at the precipice of crossing a line that, once breached, cannot be uncrossed, transforming from custodian to confiscator of sovereign wealth, fundamentally altering the trust upon which global finance depends. What makes this moment particularly dangerous is the speed at which European thinking has evolved from temporary freeze to permanent appropriation. In February 2022, few European officials would have openly discussed seizing Russian central bank reserves. By late 2024, such discussions had moved from backdoor conversations to mainstream policy proposals. This acceleration reveals how quickly established norms can collapse when political pressure overwhelms institutional caution. The magnitude of this decision extends far beyond Ukraine's immediate financing needs or Russia's economic punishment. I am observing the potential collapse of an 80-year covenant that has underpinned international monetary relations, the sacred principle that central bank reserves remain inviolable regardless of political conflict. This principle has allowed even adversarial nations to store wealth in Western financial systems without fear of political appropriation. Europe is now preparing to shatter this foundation, and the reverberations will be felt across every continent, every currency, and every sovereign treasury for decades to come. What began in February 2022 as an emergency freeze, a temporary immobilization presented as a necessary but reversible sanction, has evolved into something far more dangerous. European policymakers facing Ukraine's deteriorating fiscal position and their own political constraints are now constructing elaborate legal frameworks to justify the permanent transfer of Russian state property to Ukrainian reconstruction. They call it a reparations loan backed by Russian assets, but I recognize it for what it truly represents: the weaponization of the global financial infrastructure in ways that will fundamentally restructure how sovereign nations interact with Western monetary systems. The mechanics of this transformation reveal the depth of Europe's predicament. Brussels initially froze Russian reserves to signal displeasure and create economic pressure, believing the measure would remain temporary and reversible. However, as the Ukraine conflict extended beyond initial expectations and European public appetite for direct fiscal support waned, the frozen assets began to appear as a convenient solution to an intractable problem. Rather than commit tens of billions from national treasuries annually, European leaders could redirect Russian wealth toward Ukrainian needs, satisfying domestic political pressures while claiming moral justification. Yet this apparent solution conceals a structural trap. The legal mechanisms required to transform frozen assets into usable funds necessarily violate the principle of sovereign immunity that protects all central bank reserves. European lawyers are constructing increasingly creative justifications: temporary loans with theoretical Russian consent, interest appropriation rather than principal seizure, reparations frameworks based on wartime damages. But these distinctions collapse under scrutiny. Any redirection of economic value from Russian state assets toward Ukrainian financing constitutes appropriation, regardless of the legal language employed to disguise it. I observe that Europe's internal dynamics are pushing this decision toward inevitability, despite the profound risks involved. Germany, France, and Italy face domestic pressure to reduce direct Ukraine support while maintaining their commitment to Kiev's survival. Eastern European nations demand continued assistance, but lack the fiscal capacity to provide it themselves. The European Commission seeks to demonstrate relevance and leadership, but cannot compel member states to increase their contributions. The frozen Russian reserves appear to solve all these problems simultaneously, creating a powerful political momentum that overwhelms strategic caution. Belgium emerges as the critical resistance point in this dynamic, not from sympathy for Moscow, but from recognition of the systemic dangers involved. As host to Euroclear, the primary custodian of the frozen assets, Belgium would bear direct legal and financial exposure from Russian retaliation. Prime Minister Alexander De Croo understands what many European leaders prefer to ignore. Once Europe crosses from freezing to utilizing, it establishes a precedent that fundamentally alters how sovereign nations view Western financial institutions. The Belgian financial sector, built over decades as a neutral hub for international settlements, recognizes that its competitive advantage depends entirely on maintaining political neutrality, a principle that asset appropriation would irreversibly compromise. The short-term political benefits of asset appropriation pale beside the long-term costs of undermining the neutrality that makes Western financial systems globally attractive. The Russian response, should Europe proceed, will be swift, systematic, and designed to demonstrate that financial weaponization cuts both ways. Moscow retains leverage over nearly $1 trillion in Western corporate assets still operating within the Russian Federation. Investments in energy infrastructure, industrial production, banking networks, real estate, and consumer sectors accumulated over decades of economic integration. Russia has already tested limited forms of retaliation through forced asset sales and administrative restrictions, but a European decision to utilize frozen reserves would trigger escalation to full nationalization, punitive taxation, and redistributive measures designed to inflict maximum damage on European economic interests. More strategically significant, Russia will use European asset appropriation to demonstrate to the global South that Western financial institutions can no longer claim political neutrality. Moscow's retaliation will be accompanied by intensive diplomatic campaigns targeting nations with significant reserve holdings in European banks, China, Saudi Arabia, the UAE, India, Brazil, and dozens of smaller economies whose collective withdrawal could destabilize European financial markets. Russia understands that the precedent Europe sets with Russian assets will be interpreted by every sovereign treasury as a potential threat to their own holdings, creating powerful incentives for diversification away from Western custodians. I recognize that this dynamic represents more than bilateral European-Russian confrontation. It signals the acceleration of monetary fragmentation that has been building since the 2008 financial crisis. The BRICS nations have already invested billions in alternative payment systems, development banks, and commodity-backed settlement mechanisms specifically designed to reduce dependence on Western financial infrastructure. European appropriation of Russian reserves would provide these initiatives with the legitimacy and urgency needed to achieve critical mass, potentially creating parallel financial systems that compete directly with European institutions. The timing of this decision proves particularly consequential given broader geopolitical shifts occurring simultaneously. China's economic relationship with Europe remains substantial despite political tensions, but Beijing's reserve management strategy has already begun shifting toward greater domestic and non-Western holdings. A European decision to confiscate Russian assets would accelerate this trend dramatically, potentially triggering Chinese divestment from European markets at a scale that could destabilize continental financial systems. Chinese policymakers have been quietly building alternative infrastructure, from the cross-border interbank payment system to bilateral currency swap agreements, precisely to prepare for scenarios where Western financial systems become politically unreliable. European asset appropriation would validate these preparations and provide the political justification needed to accelerate their implementation. Saudi Arabia and other Gulf monarchies, despite their Western security partnerships, have demonstrated increasing willingness to diversify their reserve strategies in response to perceived political risks. The European Union's internal contradictions become starkest when examining the gap between political rhetoric and financial reality. European leaders publicly emphasize their commitment to rules-based international order and legal predictability, yet they are simultaneously constructing frameworks to appropriate sovereign assets in violation of traditional international law. This contradiction extends beyond immediate policy inconsistency. It reveals a fundamental tension between Europe's aspiration to global moral leadership and its willingness to employ tactics that undermine the institutional foundations of international cooperation. I observe that European financial institutions are beginning to recognize the scope of potential disruption, even if political leaders remain focused on short-term benefits. Major European banks with significant international exposure understand that asset appropriation could trigger a broader reassessment of Western financial system reliability, potentially leading to deposit flight, reduced international lending opportunities, and increased compliance costs as clients demand greater political risk protections. The European Central Bank has privately expressed concern about the precedent's impact on the euro's international standing, though these technical warnings carry less political weight than Ukrainian financing pressures. Internal ECB assessment suggests that even a 10% reduction in international euro holdings could create significant monetary policy complications, while a larger exodus could threaten the currency's viability as a global reserve asset. The cascading effects extend beyond European borders to affect global monetary architecture in ways that European policymakers have inadequately considered. International financial institutions depend on predictable, politically neutral custodial arrangements to facilitate cross-border transactions, development financing, and emergency assistance. European appropriation of Russian assets would introduce political calculation into previously technical relationships, forcing international organizations to develop new risk assessment frameworks that account for the possibility of host country asset seizure. This would increase transaction costs, reduce efficiency, and potentially fragment international financial cooperation along geopolitical lines. Perhaps most significantly, I recognize that this decision will establish precedent for how future international conflicts interact with global financial systems. If Europe successfully appropriates Russian assets without facing prohibitive retaliation, other nations will inevitably employ similar tactics during future disputes, gradually eroding the neutrality that has allowed international finance to operate across political boundaries. Alternatively, if Russian retaliation proves economically devastating, it will demonstrate that financial weaponization carries costs that exceed its benefits, potentially leading to more careful consideration of such measures in future conflicts. The strategic implications for European power projection prove equally profound. Europe's influence in international affairs has historically depended on its ability to offer attractive economic partnerships, technological cooperation, and financial services that transcend political differences. Asset appropriation undermines this soft power foundation by introducing explicit political conditionality into previously commercial relationships. Nations that might otherwise engage with Europe economically while maintaining political independence will be forced to consider whether such engagement exposes them to asset seizure risks during future disagreements. I am observing that European leaders face an impossible choice between immediate political necessities and long-term strategic interests. The political pressure to support Ukraine while avoiding direct fiscal costs creates powerful incentives to utilize Russian assets regardless of broader consequences. Yet the strategic costs of establishing appropriation precedent extend far beyond the immediate bilateral relationship with Russia to affect Europe's position within an increasingly multipolar global system. The decision European leaders make in the coming months will determine whether Europe maintains its role as a neutral financial hub, attractive to diverse international partners, or becomes perceived as a political actor whose financial services carry implicit geopolitical conditions. The temporal dimension adds urgency to these calculations. Every month of delay provides additional time for potential target nations to diversify their reserve strategies, reducing European leverage while increasing the costs of eventual appropriation. Conversely, rapid action might minimize immediate economic disruption, but would maximize the precedent's impact on international financial relationships. European leaders thus face pressure to move quickly while lacking adequate time to assess long-term consequences or develop mitigation strategies. As I analyze these converging pressures, I recognize that Europe stands at a civilizational moment comparable to the decision to abandon the gold standard or create the European single currency. The choice to appropriate Russian assets represents not merely a policy adjustment, but a fundamental redefinition of Europe's relationship with global financial governance. Whether European leaders possess the strategic vision to recognize these stakes and the political courage to prioritize long-term institutional health over short-term political convenience will determine not only Ukraine's immediate future, but the architecture of international finance for the remainder of the century. The historical parallel to the 1971 Nixon shock proves instructive. When the United States unilaterally terminated dollar convertibility to gold, it initially strengthened American monetary dominance, but ultimately contributed to decades of global financial instability. Europe now faces a similar choice: prioritize immediate political objectives at the cost of long-term systemic stability, or accept short-term political costs to preserve institutional credibility. The European Union must ultimately decide whether it values its role as custodian of neutral financial infrastructure or its immediate political objectives regarding Russian punishment and Ukrainian support. These goals have become mutually exclusive, and the choice European leaders make will reverberate through global financial markets for decades, potentially triggering the fragmentation of the international monetary system that has underpinned global prosperity since World War II. I am witnessing not merely a policy decision, but a potential epoch-defining moment in the evolution of global financial governance.